in and speaking with us here on CNBC TV18. I mean, the big story, of course, is the market itself and what it is likely to do from here after the very large fall that we saw, singularly large fall that we saw yesterday. We have Shankar Sharma, market veteran, now joining in to try and tell us exactly that. Shankar, welcome back. It's great speaking with you as always. Thanks very much for your time. A little lower as compared to when we spoke last time. As far as aggregate market levels go, what is your sense, Shankar? Especially, I mean, a day like what we saw yesterday. What's the dominating driver to your mind? Is it still fears of inflation? Is there something else into the mix now? And near term, how are things looking? Should we expect some stability, or is there much more downside from here?
Hi, Prashant. Good morning. So a lot has changed in the world since, let's say, September, August last year, right? But one thing has not changed. And the interesting thing is that the Nifty hasn't changed between August last year and now, which is whatever, 7 months or so, or thereabouts. So the Nifty actually was telling you something which, of course, most of us will ignore. Markets were intrinsically, or at least the headline markets intrinsically in India were not bullish. They were actually very, very flat, flatlining or flattish because, there was no traction coming in from, the biggies in the Indian, let's say, Sensex and the Nifty composition, which is what I tweeted yesterday. That's been my view for a while, that, banks and financials, you guys know my view. I've said this for, I think, a couple of years, that trade is, at least for a while to come, that's been over. And if you see the data on that, I was looking at it, Axis Bank, I think, is more or less flat over a 5-year period. HDFC Bank is flat over a 2.5-year period. Kotak Bank is about almost flat for the same period. I mean, RBL, of course, has been crushed. So if banks, which are 40%, banks and financial 40%, then you have Reliance, which is another, I think, 10-11%. And then you have the FMCGs, which again, my view has been absolutely clear for at least 2 years, that trade is, well past its best before date. So if you put it all together, 60-70% of the Sensex or the Nifty are really companies which are not going to deliver you stock price gains of 20% compounding. There's no way they can deliver that. Okay, but 1 or 2 might, but on an aggregate basis, it cannot. And therefore, what's left is basically broadly the IT pack, which of course, we have loved. They have made us a lot of money. But short of that, in the Nifty or the Sensex large cap segment, there has been nothing worth writing home about, and which is exactly why the market has flatlined. So it's not as if today there is something different happening. The markets were telling you a story even 7-8 months back, that the headline markets are not going to go anywhere up very soon. The action was really in the small cap space. That's where we saw a huge amount of momentum. We saw a huge amount of interest. Now that part of the market obviously is always going to be very, very, very treacherous, right? That's exactly where the damage is today. I mean, it's not the Nifty in the sense that they're still flatlining over an 8-month period.
Sure. Shankar, hi, good morning. I saw that tweet of yours where you said that, the Nifty and the Sensex could flatline, but the sizzle is in the small caps, right? There's also a lot of burn in the small caps if you get it wrong. But I'll come to that in a bit. Before that, I want to talk about certain spaces that are completely taking it on the chin right now. And one of them is the diagnostic company. So even as we speak, Metropolis is down an additional 6% after the 15% fall it saw yesterday. These are companies that are losing margins by the quarter. I mean, this is the 5th quarter now that Metropolis has shaved off margins. Do you think the growth visibility is less now in some of these pockets?
Look, here's the thing. Sometimes a good thing can become a bad thing. And for these companies, COVID came obviously as a big, literally a shot in the arm, right? And that's exactly what you get when you get a blood test done. That propelled numbers very strongly up. But the reality is that that's like a hump. If you normalize that, if you remove the effect of COVID, then they were decent businesses, but not fabulous businesses by any stretch. And in any case, I think the whole COVID thing was a racket by a cartelization of all these companies. I mean, I go to the airport to fly back to Dubai often, and I pay 4,000 rupees for a rapid test. 4,000 rupees. I mean, it's ridiculous. Why an average traveler, let's say you're flying economy class, you're flying to Dubai, you're paying 10,000 rupees for a ticket, you're paying 4,000 rupees for a test. So I'm happy if their margins are shrinking, because what they have done is really price gouging at a level which is unimaginable. So, it's all okay. They made hay while all of us were suffering. Now let them suffer a bit.
On the front foot, Shankar Sharma. Well, Shankar, you have made this point that India has solid buffer in form of domestic liquidity. Now we have this LIC IPO that's likely to come in there. And that's what could, send things in a bit of a tizzy, because FIs are selling. The LIC IPO could drain out a lot of domestic liquidity as well. Your view on it?
So I think the LIC IPO will drain out liquidity, but I don't think it will drain out liquidity directly from the small investors to LIC. I doubt if the new entrants, the 4-5 crore new demat account holders, are going to be jumping at the IPO market anytime soon, even if it's LIC, a haloed company like LIC, because obviously a lot of stupid decisions were made by a lot of uninitiated investors in investing in new age companies. I don't think demand for LIC is really going to come directly from the let's say the small investor retail category. It'll have to be coming from the mutual fund segment. It'll also come from the FPIs, because remember this, that I've been in the business 30 years and I've often scratched my head when FPIs go or FIIs back then used to go and put money into all kinds of really, I'm not saying LIC is one, but I'm talking large cap company IPOs, when there were no really solid fundamentals. They would say it doesn't matter. We have to be investing in the largest or the large companies in a country. That's the way we are benchmarked. So LIC is the big 800-pound gorilla. They will put in money, even though the stock might lose money after the IPO. That's okay, but that's the way institutional investing works. You cannot sit out a huge IPO like LIC. So I don't think LIC will really suck out directly from retail investors the liquidity into the market.
Okay, Shankar, so, prices have come off, stock prices have come off, and the broader markets more, and large caps as well, really. So I guess what we can do is look at, try and see what one can buy. I mean, the regular guy out there with time on their side to make and to expect reasonable returns from here. So which are those pockets, Shankar? Or do you think one should hold out a little bit more? Just run us through how you're thinking about actionable things from here.
So at least my thinking, I can only share my thinking. There's not investment advice, and everybody should seek their own counsel. My thinking right now in the markets is that a lot of companies are out there. I mean, I went on a tour of India, I think, 2.5 months back. I went to several cities, met a lot of big and medium-sized companies, even small companies. And I came back and I was chatting with a very close friend of mine who's a fund manager. I was saying that I hear only bullish tales. Is it the stock market driving this bullishness? Or is it that core businesses themselves are suddenly so bullish that they have never been so bullish in the last 15, 20 years? I think in large part it was the stock market driving the bullishness of promoters. That's cooled off a bit because their stock prices are down 20, 30, 40%. What that means is that, and I find this, and I'm saying this, with complete clarity, I find that the market, especially in the mid and the small, particularly in the small cap space, has a lot of value. I mean, I'm seeing stocks with reasonable earnings visibility. It's like, I would say, nothing's got 100% visibility, but let's say 80, 90% confidence of numbers in 22, 23, trading at 5 times, 4 times, 7 times, 8 times earnings. I mean, that's really cheap by any standards. So, and those stocks have come down 20, 30%. They were like 10, 12 times earnings. They're down to 7, 8 times earnings. I think it's a great time if you have some money left, left over, or you at least cashed a bit of your profits out, to be out there bargain hunting. I really think it's a great time. The market has reverted back to what it should, which is, bottom-up stock picking. There's a great market for that.
Okay, the operative phrase is if you have any money left, right? After the kind of fall that we've seen recently. But, well, jokes apart, Shankar, you've been talking about small caps for a while. Leave us with some ideas. If you don't want to talk stocks, at least tell us about, what are the pockets that look attractive to you? Which are the big themes that investors can look at in the small cap space?
So in the small cap, I mean, I continue to like the chemicals play. I think that's a great space. That has been a great space for nearly, I think, 10 years now since, we first stumbled into that sector in 2011 or 12. I continue to believe the China plus one. I talk to companies. I realize and I get this very constant refrain that, a lot of that business will move to India. It is moving to India. Global companies don't want to necessarily buy their back-end chemicals from China anymore to that extent. That's a secular theme for sure, without any doubt. Second thing, of course, is that commodities, you need to find places which are, to some extent linked to the commodity cycle. I understand commodities are very volatile, but the reality is that this bull market in commodities, in my view, could run a few months before it, ends. Typically, commodity prices, run 3-4 years before they halt, like, 2003 to 2007 is the latest example of that. I think this bull market is about 2 years old in commodities, started April 2020. I think it might run 6 months, maybe 12 months. So therefore, you need to buy companies which are benefiting from the cycle. At the same time, companies which are not getting hurt by the cycle, because again, companies are getting hurt. I'm sure on your channel, many companies come and tell you that raw material prices are really on the upswing. End product prices cannot be passed on yet. Therefore, there is a squeeze on margins. Then we are looking at least avoiding those spaces where you are getting hurt by RM prices, but there are enough spaces which are benefiting from these. And I said chemicals is a great place.
Shankar, I'm looking at it. Ishan Dyes, it's one of the smaller company stocks that you have bought. It's already been disclosed on the exchanges, so I'm just citing that, and our viewers will be well aware of that. But any other stocks you could name that you would be bullish on from here on?
So obviously, once I buy, only then I can disclose. But I can tell you that there are more options than I have money. So I'm really spoiled for choice. I really am spoiled for choice, which should tell viewers that if you work hard in this kind of market, you will build a solid portfolio for the next 5 years.
All right. I was trying to get a couple of names, but I guess we'll have to keep tracking the large trades and the disclosures on the exchanges. The Nifty has moved into the red, so let's shift focus to a couple of other asset classes. What should the allocation to gold be? In these sort of volatile times, should there be some allocation out there? And also the Bitcoin, in the past, Shankar, you have said, you'd be positive on cryptos on the whole. Do you believe still that you'll be positive from here on?
So understand this, when I say I'm positive on cryptos, okay, it is from an asset class perspective. It doesn't mean that every price I like and every price has to be a buy. Okay, it's a very volatile class. I don't think any sensible investor should be putting more than 1 or 2% of their allocations into that. So that's where my view stands. I think the asset class is here to stay, irrespective of what taxation comes and whatever governments want to do with it. So that said, gold is a flatlining one. We will see whether gold and the inflation trade works out. But my larger point here, Nigel, is this. This fall is taking us back to the fundamental, which is what I have always professed on your channel and other places, that it's about asset allocation. It's not about just chasing a Nifty permanently, because the Nifty or the NASDAQ is never going to give you every year positive returns. It's not going to happen. So investors in our PMSs, in our fund will come and say, no, I want 100% equity exposure. And the only thing I can tell them is, look, the day it comes down 15%, you're going to come back and try, why did I not listen to this whole mantra of asset allocation? Because asset allocation looks like the most idiotic idea when there is a bull market in equities. And it looks like a genius of an idea when there is a bear market, or at least a correction in equities. So it just brings us back to those learnings. Markets are a great learning place if you're willing to be a good student. Please do not put everything 100% in equities. So fixed income has got some role, gold has got some role, real estate has got some role. Don't just neglect them and say 100% goes into equity. So this is a great time to be revisiting the fundamentals.
Okay, we got that. But I'm glad you put it on board that don't have more than 1 to 2% exposure in cryptos. We've seen the kind of massive correction that cryptos have seen, right? Yesterday when the equity market fell 3%, I follow someone on Twitter who put out a tweet on cryptos where he said that if there's a 3% slide in cryptos, people don't even open and take a look at their portfolio. I mean, that's the kind of fall that the crypto market sees. So equities is really a small fall that we've seen up until now. But thanks a lot for pointing out the volatility there, Shankar. Have a great day, and until we meet again, stay safe. Okay, that's the word coming in on the market. By the way, the mid-caps are now selling off rapidly, down almost 200 points for the mid-cap index. The Bank Nifty is well in the red. So we have our own share of volatility to deal with today as well. Let's take a quick break. Up next, we'll get the technical guests on board. The experts will tell us how to position yourself in this volatility. Mitesh Thakkar will be with us for some trades.